Welcome to the Captain's Blog. I'm Dave McDonough, president and founder of Flagship Wealth. On this blog, we try to take what's unnecessarily complicated back here on Wall Street and make it understandable to you on Main Street. We finished up last week up 4% for the year, and again, a record run, best run in decades from the end of October through the end of January. Why, you ask? Rate cuts are baked into the cake here, folks. People expect that the Fed will start cutting rates in March. But we warned you at the end of the blog last week that Fed Chair Powell will go on 60 Minutes over the weekend and talk down those expectations. We also warned you that there'd be geopolitical risk and that we, our military, would respond to attacks on our soldiers. Did these two actions reign in the positivity parade? Here's your week in review. On 60 Minutes on Sunday, for those of you that still watch it, Fed Chair Powell said, please, folks, be patient. We're not there yet where it comes to fighting inflation. We are not there yet where it comes to cutting interest rates. Remember, the Fed would cut interest rates to spur economic growth. Again, jobs numbers above expectations, GDP above expectations, you as the consumer at a confidence level we haven't seen in years. And yes, lastly, inflation is coming down, although we don't see it at the grocery store or the pump, and the government data, it does show that. Well, as a result of that, interest rates started to go back up with the prediction and the expectations that the Fed cuts would be pushed to the summertime. Now, again, folks, in my opinion, this market is fully valued, and there is a crowd out there, the fear of missing out crowd, that is chasing the AI. See what I just did? That was chasing. And buying names that they don't know what they do or how to pronounce. And as predicted, we did respond to the attacks on our soldiers in the Middle East. And as a result, oil has spiked. Again, less money in your pockets. So as of this print, the market is relatively flat for the week, and we'll take it. And here's what to look for next week. Again, we'll be paying attention to the economic data, specifically the employment data. Repeat after me, class. Good news is bad news. Good news is bad news. Where it comes to the Fed, if the market is running hot, they're still concerned about inflation. There is no reason for them to be talking about cutting rates. And I'm quite certain that next week the Fed governors will be on their tour explaining just that. Be proactive in your portfolios. Rebalance. Remember why you're in the market to begin with. Look at your risk tolerance, your time horizon, and reallocate accordingly. Consult your local financial advisor for more details. Here's your personal finance tip of the week. A number of out there asked me, hey, Dave, what should we pay attention to when it comes to the market? Well, years ago, it was the Dow Jones, 30 stocks. And a perfect example of why I don't recommend following the Dow. One name can affect the entire index. While the market was relatively flat yesterday on Thursday, Disney came up with great earnings. I'm not telling you to buy, sell, or hold the stock. What I am saying is this. It was up 10% yesterday. So the Dow, the market, looked like it was up, while the rest of the stocks were flat to down. My opinion, the best index to follow when you want to hear about the market is the S&P 500, the largest 500 stocks in the country, a broader measure, and again, something that is more reflective of what's going on in the market. So thanks again for checking in. We'll see you next week on the Captain's Blog.